I want to ask you some issues, many issues, business issues, personal issues. No, we'll stick to business today. Just in relation to superannuation taxes, or is that revenue?
No, that's us, Senator.
Righto. So the draft legislation on the new super tax defines superannuation earnings as the difference between the balances over a period. So is that a tax on assets, not earnings?
I might ask Mr Hawkins or Ms Kelly. No,
Lynn Kelly, First Assistant Secretary, Retirement Advice and Investment Division.
Yeah.
So the way that the tax is calculated is by comparing the opening and closing total superannuation balance. The reason why this methodology is adopted is because super funds earnings are actually typically calculated at a fund level, not at a member level.
Yeah.
And so we needed to have a methodology that was capable of being implemented across the entire superannuation system. Whilst maybe possible for a self-managed super fund to work it out on an individual level, given that it's estimated about 30% of affected Australians actually have an interest in APRA.
So it's a tax on assets?
We needed a methodology that was capable of being applied across the whole industry.
Okay, so it's a tax on assets, thank you.
Sorry, that's not what I said. No, it's a tax on the movement between assets, and that movement, when you take away contributions and you take out withdrawals, it then looks at the movement as a proxy of earnings.
So it's
tax
income
on
and growth.
Income and growth, yes.
So you're taxing growth.
Taxing balances.
Taxing the movement in the balance, yes.
Yeah. Okay. Grows or doesn't grow, it gets taxed.
So if it grows, it gets taxed to the extent of the portion above $3 million. If it doesn't grow, there's a loss that's carried forward to future years.
I asked you about whether there were other plausible examples around the world where there were taxes on unrealised capital gains, and the answer that the Treasury gave was, quote, there are examples of the taxation of unrealised capital gains in other jurisdictions. So that's quite a good answer.
One sentence.
Well, it was a good start, I thought. So look at the G20 or you look at OECD comparisons, we would be, by moving to this system, tax on the way in, tax on earnings and tax on the way out. And on balances, so 4 points.
So this tax is estimated to only apply to 0.5% of Australians, and so the 99.5% of Australians will have no tax on the way out.
Yeah.
Sorry, but it's not indexed.
No, it's not indexed. The thresholds with which we apply tax typically are indexed, like Division 923 is a comparison in the superannuation system where both the threshold and the rate is determined by the Parliament.
But Div 293 is based on your income. It's determined by your income, not your balance. So this is unrealised, tax on unrealised capital gains on your balance, on your wealth, and it's not indexed. So of course more people are going to fall into that net as they get older. How many 25-year-olds today on an average wage are going to fall into this net under the current settings of this legislation?
So we don't typically do estimates outside of the forward estimates. The 35-year-old with a balance of about 70,000, which is around the average for that age group, who earned the average income for their entire working life, would not be expected to retire with a balance of $3 million or over.